Everyone tells you the same lie about starting a real estate holding company. That you need $2 million sitting in a business checking account before anyone takes you seriously. That you need a broker on retainer, an acquisitions team, a guy named Chad with a Bloomberg terminal. You believe that lie for exactly as long as it takes you to open a free ChatGPT account on a Tuesday night with $340 in your checking account and a laptop that's older than your last relationship. Turns out the barrier to entry was never money. It was an analyst. And you just hired one that works 24 hours a day, never asks for equity, and doesn't need health insurance. This is level 0. No capital, no team, no Chad, just you, a browser, and a stack of AI tools doing the job that used to require a junior analyst pulling 80-hour weeks at a REIT for $58,000 a year and a promise of exposure. You are that analyst now, except you don't sleep when the model runs, and you don't need 3 years of training to know what a cap rate is. You need a prompt. Here's where it actually starts. Not with a deal, with a scrape. You point a tool like PropStream or Reonomy at a zip code you've driven through 100 times and never once thought about owning, and you start pulling off market inventory. Absentee owners, properties with 20+ years of tenure. Tax delinquencies, pre-foreclosure filings, the stuff that never makes it to Zillow because it was never supposed to sell in the first place. That's the entire game at level 0, finding motivated sellers before a human broker even opens their inbox. But a list of 4,000 addresses is useless to you. You're one person, you don't have a call center, so you feed that list into a scoring model, sometimes something as simple as a spreadsheet wired into Claude or GPT through an API, sometimes a no-code tool like Clay layered on top, and you tell it exactly what a good deal looks like to you. High equity, low mortgage balance, absentee owner, held more than 15 years, in a zip code with rent growth above 4% year over year. The AI ranks all 4,000 properties in the time it takes you to make coffee. A human analyst would need 2 weeks and a headache. You have a ranked list before your coffee's cold. Now the part that used to be the actual bottleneck. Underwriting. This used to mean days. Pulling comps manually off the MLS, building a rent roll by hand, running a pro forma in Excel that you triple check because one fat-fingered cell ruins your cap rate math and you don't notice until you've already told the seller you're in. You don't do any of that anymore. You feed an address into an AI model connected to comp data, and in minutes you've got an underwriting snapshot. Purchase price, estimated rent roll based on comparable units within a half mile, projected cap rate, cash-on-cash return, even a rough DSCR, if you're already thinking like a lender is going to think. What took a junior analyst 3 days at a private equity shop now takes you the length of a YouTube ad you didn't skip. You're still at $0 in capital, but you're not at 0 in credibility, because credibility right now isn't your bank balance. It's your speed and your data. And speed is the one currency you actually have more of than the guy with $2 million and a slow due diligence team. Now you need sellers to actually answer the phone. This is where most people at level 0 quit because cold outreach feels humiliating when you're doing it manually, one email at a time, sounding like a nervous intern. So you stop doing it manually. You build outreach sequences with AI, personalized cold emails and texts that reference the actual property, the actual owner, the actual number you calculated, not some generic I buy houses template that gets deleted before it's even read. Tools like Instantly or Smart Lead running the sends, GPT drafting the variations so every message reads like a human wrote it at 2 a.m. because they actually cared, not like a bot blasted 500 identical texts. You send 200 messages in the time it takes to write 4 good ones by hand. Sellers start replying. Not all of them, not even most of them, but some. And this is the moment level 0 quietly becomes level 1. One seller calls back, one wholesaler with a distressed triplex he can't move fast enough messages you at 11 p.m. because your underwriting deck, the one your AI stack built in 9 minutes flat, looked more professional than the guy who's been doing this for 6 years and still uses a napkin math approach. You don't have the money to close it yourself. You never needed to. You bring it to a JV partner, someone with capital and no time, and you hand them a package that answers every question before they ask it. Purchase price, comps, rent roll, projected returns, exit strategy, all generated, cleaned, and packaged by a machine that costs less per month than a single Chipotle habit. That first deal, JV or not, isn't really about the deal. It's proof of concept. It's the receipt that says the model works, that a person with 0 capital and 0 team can source, underwrite, and close using nothing but automation doing the job a $70,000 a year analyst used to do badly. It's small. It might net you a few $1,000s, or just a track record and a case study you can point to. But it's the exact moment the whole thing stops being a hobby with a spreadsheet and starts being a business with a system. Because once that first deal closes, the question isn't can this work anymore. It's how many of these can I run at once? And that question is what drags you, whether you're ready or not, straight into level 2. Every operator who scales past their first deal makes the same mistake at the exact same moment. They get their first real check, the wire actually clears, and their instinct is to hire a part-time property manager, an assistant to handle emails, someone named Kayla who's great on the phone. That instinct is the thing that kills the model before it ever gets big. Because Kayla costs $45,000 a year plus benefits, and Kayla can only manage one thing at a time, and Kayla goes on vacation, and Kayla eventually wants a raise or a title or both. You don't hire Kayla. This is level 2. You reinvest that first profit straight back into the stack, and instead of one employee, you buy infrastructure that scales the same way whether you own 3 doors or 300. Here's what that actually looks like. Your deal pipeline, the one that used to be a spreadsheet you manually refreshed at midnight, becomes an actual system. You're running scrapers against MLS feeds, off-market databases, county recorder filings, and probate records simultaneously, all day, every day. No browser tabs open, no you required. Hundreds of listings and leads a day, not dozens. And instead of you eyeballing each one, an AI ranking model, the same logic from level 0 but now running as a live pipeline instead of a one-off spreadsheet task, scores every single property the second it hits the feed. Equity position, seller motivation signals, rent-to-price ratio, days on market, tax delinquency status. It spits out a ranked list every morning before you've had coffee, and the deals worth your actual attention float to the top automatically. You went from finding needles in haystacks to having a machine that only shows you needles. Underwriting scales the same way. At level 0, you are pulling comps for one address at a time. At level 2, you've got underwriting models plugged directly into live market data feeds, rent comps updating in real time, cap rate benchmarks by submarket, vacancy trends pulled from actual leasing data instead of guesswork. You paste in an address, or increasingly, you don't even do that because the pipeline hands it to the underwriting model automatically, and what comes out the other side is a live, defensible pro forma. Not a static PDF that's stale by the time you present it. A model that updates itself if rent comps shift or a cap rate benchmark moves next week. You're not underwriting properties anymore. You're running a machine that underwrites your entire market continuously, whether you're looking at it or not. Now you own actual doors, more than a handful. And this is where most people at this stage quietly drown, because property management was never designed to scale linearly. One tenant with a leaking faucet is annoying. 40 tenants with 40 different problems on a Tuesday is a full-time job for 3 people. So you don't hire 3 people. You deploy an AI chatbot layer, tools built on top of GPT-class models wired into your property management software, and it handles tenant communication the way a human never could at this volume. A tenant texts about a broken garbage disposal at 11 p.m. The bot triages it immediately, asks the right follow-up questions, determines if it's an emergency or a Monday morning fix, and automatically dispatches the right vendor from your maintenance network without you ever seeing the message unless something actually breaks down. You wake up to a summary, not a queue of 40 unread texts and 3 voicemails from someone's aunt. Lease renewals used to mean someone manually tracking a spreadsheet of expiration dates and hoping nobody forgot to send the notice 60 days out. Now that's automated too. The system flags renewals coming due, drafts the renewal offer based on current market rent data pulled from the same feeds your underwriting model uses, sends it, and follows up if the tenant goes quiet. Rent collection reminders go out on autopilot, delinquency follow-ups escalate on a schedule you set once and never touch again, first a friendly nudge, then a formal notice, then a flag to your actual team if it crosses into something that needs a human. You didn't hire a collections department, you configured one. And here's the part nobody tells you matters as much as the deals themselves. Once you're managing other people's capital, even a little of it, even one JV partner who wired $80,000 into your last deal, you need to look like you run something bigger than you actually do. AI-generated investor updates handle that. Monthly reporting, portfolio performance summaries, cash flow breakdowns, all pulled automatically from your live data and formatted into something that reads like it came out of a firm with an actual back office. Your investors get consistent, professional, on-time updates every single month, and they have no idea it took you 4 minutes to review and approve before it went out. Trust compounds the same way returns do, and trust is the only thing that gets you the next bigger check when you go raise again. This is level 2, fully built out. Pipeline, underwriting, property management, investor relations, all running on automation instead of headcount. And it works beautifully until somewhere between $1 million and $50 million in portfolio value, it doesn't. Not because the AI stops working, because you do. You're the one still approving every deal manually. You're the one who has to review every chatbot escalation personally because you never built the decision tree wide enough. You're the one who's now the bottleneck standing in front of a machine that's ready to move faster than you are. That's level 3, not a new tool, a new problem. The portfolio has outgrown the version of you that was still doing spot checks on everything, and the only way through is full systemization, handing off the judgment calls too, not just the busy work. Which is exactly the kind of problem you can't solve with another automation. You solve it by building infrastructure that doesn't need you standing over it at all. Somewhere past 50 million, the entire frame you've been using breaks. You've spent every level so far thinking in single assets. This deal, that tenant, this refinance. Level 4 is the moment you stop being able to afford that because now you don't have a property. You have a portfolio, and a portfolio doesn't behave like the sum of its parts. It behaves like its own organism, and it needs its own brain. That brain is a portfolio-level AI decision engine, and it's a different animal than the underwriting model you built back at level 2. That one told you whether one deal made sense. This one looks at 85 deals at once and tells you what the whole thing needs. It's pulling in every asset's performance data, every submarket's rent trend, every loan's maturity date, and every dollar of dry capital sitting uninvested, and it's making recommendations a human analyst would need a team of 12 and 6 weeks to produce. You ask it a question like, where's my portfolio overexposed, and it doesn't give you a feeling. It gives you a number. 41% of your equity is sitting in 3 submarkets with correlated risk. That's not something you sense anymore. That's something the machine calculates while you're asleep. Capital raising changes shape at this level too, because now you're not chasing your first JV partner with an $80,000 check. You've got family offices, you've got institutional allocators, you've got people who want to see a track record formatted the way their compliance department expects it. So you stop doing outreach yourself. You build an AI-driven investor CRM that tracks every LP relationship, every conversation, every commitment level, and it doesn't just store the data, it acts on it. It flags which investors are warm and ready for the next raise based on how they engage with your last 3 updates. It auto-generates the deal room the second a new acquisition closes, pulling financials, photos, market data, and projected returns into a package that used to take an analyst a week to assemble. And the pitch itself gets personalized at scale, the same base deck reshaped automatically depending on whether it's going to a pension fund that cares about downside protection or a family office that cares about upside and legacy. You're not writing 40 versions of the same pitch anymore. The system is. Maintenance stops being reactive around this level too, and it has to, because a leaking faucet across 40 units was a chatbot problem. A roof that's going to fail across 11 properties in the next 18 months is a forecasting problem. Predictive maintenance models now run continuously across your entire portfolio, ingesting HVAC runtimes, roof age, plumbing material by property vintage, and even weather pattern data by region, and they're not telling you what broke. They're telling you what's about to. Your CapEx forecasting stops being a spreadsheet someone updates quarterly and becomes a live number that shifts every time a new inspection report or sensor reading comes in. You know today, with real confidence, what your capital expenditure looks like 18 months from now across 120 doors, and that number used to not exist as a number at all. It used to exist as a guess someone made in a boardroom. Then there's the question that actually built or destroyed every real estate fortune in history, and it's the one level 0 you could never have answered. When do you buy, when do you hold, and when do you sell? At this size, that decision isn't made asset by asset anymore. You've got automated market timing models running across every metro you operate in, tracking interest rate movement, cap rate compression and expansion by market, migration data, employment growth, permit activity, and construction pipeline, and they're generating a live recommendation for every single asset in your portfolio every week. Not a hunch, a ranked signal. This asset in Phoenix is sitting in the 92nd percentile for sell timing based on cap rate compression and rent growth deceleration. That one in Charlotte should be held another 36 months based on projected supply constraints. You're not calling 6 brokers and reading 4 newsletters to guess this anymore? The guess got replaced with a model, and the model doesn't get tired and doesn't have an ego about being wrong. Debt is where most operators at this size actually blow up, because debt doesn't wait for you to have a good week. Rates move whether you're paying attention or not. So you build AI-driven debt monitoring across every loan in your portfolio, tracking rate exposure, maturity dates, prepayment penalties, and refinancing triggers in real time. The system flags the moment a refinance opportunity crosses a threshold worth acting on, the moment a floating rate loan's exposure crosses a risk band you set, the moment a maturity is close enough that you need to be in a lender's pipeline right now instead of in 6 months when everyone else notices too. You're not reacting to a rate environment anymore. You're getting a 2-month head start on everyone still checking rates manually. And here's the part that actually changes what your company looks like on an org chart. All of this used to require headcount. A traditional shop this size runs a team of asset managers, a research desk, a debt specialist, analyst pulling comps, someone dedicated purely to LP reporting. You don't build that team. You build an AI-augmented team instead, 5 or 6 sharp people who each operate like they're running a department because the systems underneath them are doing the work that used to require 20. You're not replacing judgment, you're replacing the layers of overhead that used to exist just to feed judgment the information it needed. That's level 5, when it actually locks in. The portfolio starts optimizing itself. Deals get sourced, ranked, and flagged without you touching a feed. Capital gets raised through a pipeline that runs whether you're on a plane or not. Debt gets monitored and refinanced on schedule the system built, not the one you remembered. And for the first time since you opened that first gate at 6 a.m. with a spreadsheet and a dream, your actual job stops being operations entirely. Your job becomes capital and strategy, nothing else. The machine runs the company. You decide where the company goes next. Somewhere past 250 million, you stop being the person who runs the company. You become the person the company reports to. That's the actual definition of level 6, and it's a strange one to sit with, because nothing about the day-to-day feels dramatic when it happens. There's no ribbon-cutting moment. You just notice one Tuesday that you haven't manually reviewed a deal in 3 weeks and the portfolio grew anyway. Acquisitions now run on a first-pass autonomous model. The system isn't asking you whether to look at a deal anymore. It's telling you it already looked, already ran the underwriting, already compared it against your fund's return thresholds, debt capacity, and geographic exposure limits, and already decided it clears the bar. Your job shrinks down to a single motion, sign off or don't. Same thing on the disposition side. The market timing model from level 5 that used to hand you a ranked list now hands you a drafted decision. Sell this asset in Phoenix in the next 90 days. Here's the broker package already built. Here's the pro forma already stress tested against 3 exit cap rate scenarios. Refinancing works the same way. The debt monitoring system doesn't flag an opportunity and wait for you to act on it anymore. It drafts the term sheet request, pre-fills the lender package, and puts it in front of you the way an assistant would put a letter in front of you for signature. You're not managing decisions at this level, you're ratifying them. And that shift changes what kind of capital you can even take. Up until now, every dollar that came in required a human being to build a deal room, walk an investor through a deck, chase a wire, and update a spreadsheet with who committed what. At 250 million and up, that doesn't scale, not because the money isn't there, but because the paperwork behind the money isn't there. So you build automated syndication and fund structuring into the stack itself. New capital commitments trigger auto-generated subscription documents. Waterfall structures get modeled and adjusted in real time as allocations shift. A pension fund wants a different fee structure than a family office? Fine. The system builds both versions of the fund docs without a lawyer redrafting language from scratch every single time. This is the machinery that lets you absorb $100 million from 3 institutional allocators in the same quarter you're closing on 40 new doors without adding a single person to a back office. The dashboard is where you actually feel the size of what you built. Hundreds of properties, and you can see every one of them breathing in real time. Occupancy by asset, rent collection variance by market, maintenance backlog by property age, debt service coverage ratio recalculating itself the second a new NOI figure lands. This isn't a quarterly report anymore. It's a living organism you can check from a phone in an airport lounge, and it tells you, without you asking, which 5 assets out of 400 need your attention today, and which 395 don't need anything from you at all. That's the part nobody explains to you back at level 0, sitting there with a spreadsheet and a dream. The goal was never to see everything. The goal was to build a system that tells you the 2 things that matter and shuts up about the rest. And then there's the exit question, the one that used to terrify operators your size because it required an investment bank, 6 months, and a small army of consultants just to figure out which door made sense. Recapitalize, convert to a REIT, sell the whole platform outright. Now the automation that's been running your portfolio for years is the same automation that models every exit scenario against your actual data, not hypothetical data some banker built from comps. Want to know what a REIT conversion does to your cost of capital and your tax structure? The system's already run it because it's been sitting on every asset's real performance history the entire time. Want to know what a full portfolio sale nets after debt payoff and carried interest in this rate environment versus 18 months from now? That's not a 6-week banker deliverable anymore. That's a report your system generates overnight. Here's the thing worth sitting with for a second before you close this out. Every single level you just walked through, 0 to 1, 1 to 50, 50 to 250, 250 to 500, was never actually about the money. It was about finding the bottleneck that was a human being and replacing it with a system that doesn't get tired, doesn't have an ego, and doesn't need Tuesday off. Level 0 replaced the analyst spending 40 hours running comps. Level 2 replaced the person manually chasing every lease renewal. Level 4 replaced the 12-person team it would have taken to see across 85 deals. Level 6 replaced you, at least a version of you that used to be the bottleneck standing between a good deal and a signed one. That's the whole blueprint, start to finish. Not a fluke, not a lucky market, not a viral deal. A level-by-level replacement of exactly the thing slowing you down over and over until the company runs itself and you're the one deciding where it goes next. But here's what almost nobody tells you before they hand you this blueprint. There's one mistake buried in this exact stage that's quietly ended platforms bigger than the one you're building, and it's not a bad deal. It's scaling the automation faster than the legal and financial structure underneath it can hold, syndicating capital through systems that were never audited for the compliance load institutional money actually requires. It's the kind of mistake that doesn't show up for 4, 5, 6 months, right until an allocator's council asks one question your fund docs can't answer, and by then the fix costs 7 figures and half your credibility with it. I break down exactly where that failure point sits and how to build around it in the book. Links in the description. Go grab it before you hit this level for real.